Well, welcome to one more segment of our video instruction. This one's on the risk management applications of option strategies. It's not too long. We've got some numbers in it, but a few things to explain. I think you'll enjoy it. Let's jump right in. We've got a graph here. What we've plotted out here is the payoff at expiration for a call. First a long call and then a short call. So just to review, here's our exercise price. If the price of the asset is less than that at expiration, then the payoff is zero. The option expires worthless. And if the option is in the money at expiration, your long call position just pays dollar for dollar. So we would make $5 if the price at expiration is 55. It's $5 in the money at expiration. On the other hand, the short, who's required to sell the asset, if the call holder buys the asset at the exercise price, well, their payoff is just the opposite. So if the long call makes a payoff, receives a payoff of $5 at expiration, the short has to pay out $5 at expiration. So that's what we would call a zero-sum game, and there's the payoff to the short if the asset price is $50 at expiration. So those are just payoffs if you owned it. We didn't look at any kind of a profit and loss. But we can do the profit and loss. All we have to do is assume some call premium. What did we pay for the call? Well, now if we paid $5 for the call, remember that if it's $5 in the money, and these prices have changed a little bit, but that shouldn't change much, here we have our exercise price of $40. At 45, it's $5 in the money. The payoff is $5, so that's break even. If the owner of the call paid $5 for it and receives a payoff of $5 at expiration, we're going to call that break even. And so that's also break even for the short side of the transaction, the writer of the call who promised to sell the asset at 40. Well, at 45, the seller at 40 is out $5, but that's just what the seller received when they wrote or sold the option in the beginning. So the break-even price is the same for both of them, and they'll break even if the payoff at expiration is just equal to what they paid for the call. So big diagram to explain that, but it really helps sometimes to draw these diagrams. Let's do the same exercise for a put. The put is worth zero if the price of the asset at expiration is higher than the stock price or the asset price. And if the price at expiration is less than that, then we have a positive payoff to the long and an equal negative payoff to the short on the put option. And what's the most you can make on a put option with an exercise price of 50? Well, your largest payoff would be $50 if the stock price fell to zero. And in that case, the writer of the put would be out $50. They'd have a negative payoff at expiration. So again, if we want to talk about profit and loss on the position, we need to introduce the price of the put that the long put paid to the put writer at initiation here. So again, we've used a $5 put premium. We've got now an exercise price of 40 here and here. So now where's break even? Well, the put premium was $5. So if the payoff is $5, that's break even. The put payoff is $5 if it's $5 in the money, and with a $40 exercise price, it's $5 in the money. If the asset price, stock price at expiration is 35, and positive profits if the price is lower than that. Now, what is our maximum profit here is 35 because the exercise price is 40 and we paid 5 for it. So our maximum profit is 35. The maximum loss for the writer of the put, who must buy the asset from the long at 40, is minus 35. So again, it's perfectly symmetric between the long put owner and the short, the put writer. So now we're going to talk about a strategy that we haven't seen yet, a covered call strategy. In a covered call strategy, the writer of the call option owns the stock and sells a call. Well, when you sell a call at 30, essentially when you own the stock, what you've just done is sold off any upside above 30. Up to 30, it's all yours. You sell a call at 30. If the stock at expiration is higher than that, you've sold that off. But you've received a payment right now to do this. So any loss will be reduced by the premium you received. So if I buy a stock at 30 and sell a call for $5, my net cost of that position is $25. So it's lowered my break even. It's reduced my losses if things go wrong. But what's the trade-off? We've sold off the upside. If that stock price goes to 100, we've sold a call with an exercise price of 30. We get 30 for our stock even though it's trading for 100 in the market. So that's the trade-off when you write a covered call. We could draw that out as well. Here is the stock. We own a share of stock. We bought a share of stock. And so that's just our 45-degree line, right? Our payoff is dollar for dollar because we're plotting it against the stock price, and we're talking just the payoff at this time. Now, what if we sell this call? Well, here, we're going to sell that call for 30, so our net cost of the position is reduced to 36, so that becomes our break even. Break even in the sense that if the stock price is $36 at expiration, the call we sold expires worthless. It's out of the money. We sold a call with an exercise price of 40. So all we have is the stock. So if the stock's at 36, we get 36. That was our net cost of the position, and that's when you run into questions on this. That's one place you might stumble. When you say, what's your gain or loss on a covered call position, look at it as the whole position. What did the whole position cost net? In this case, selling the call reduces our net cost. So let's do an example, because the learning outcome statement said you're supposed to be able to figure all these things out. So let's just run through it. We're going to sell a 40 call for $3. We're going to buy a stock at 39. What's the net cost of the position? Well, we paid 39 for the stock. We took in $3 when we sold the call. So that position, net cost $36. What's the break-even stock price at expiration? $36, right? Same as we saw on the diagram. Just make back our net cost. Stock's at 36. We get 36. Calls out of the money, worthless. 36 is our break even. What's our maximum gain? Well, let's see. What's the best that can happen? If that stock price is 40 at expiration, the call expires worthless. It's just at the money. It's not in the money. We're in this $36. We'd get 40 for our stock. We'd have a gain of $4. Well, what if the stock price goes to 100? Well, we sold calls at 40. So we still get 40 for the stock. Our gain is still $4, or $4 a share anyway. And so that's our maximum gain. What's our maximum loss? Well, if that stock price goes to 0, you've lost $36. That's your net cost of the position. Stock price goes to 0. Nobody cares about the call at 40. Your stock's worth 0, you get 0, and you're out $36. And lastly, you should be able to calculate the profit or loss at a stock price of 39. Well, 39, the call's out of the money, expires worthless. We're in at 36. We get 39 for our stock. I'm thinking $3 is our profit. And how about at 32? Well, The $40 call option is still worthless at any price below 40, so we don't have to worry about that. If the stock price is 32, we get 32 at option expiration, nothing else. We were in at 36, our loss is $4. So make sure that you understand all of those steps, and given that right there, be able to come up with all of those in a reasonably short period of time. Okay, we've got one other strategy to talk about here, and we saw it before when we derived put-call parity. We talked about a protective put. A protective put, we're going to buy the stock and we're going to buy a put. Now remember, I said when you sell a call, I want you to think about, hey, I just sold off the upside above the exercise price and I got this much for it. Well, here I want you to think of it as just buying insurance. The put gives us the right to sell these shares of stock for the exercise price. So that's the least we'll ever get. We've insured our downside risk, but what did we give up? We gave up what we paid for the insurance. So that's going to raise our break even because we bought the insurance, but it's going to put a floor on the downside, and we really haven't given up the whole upside. The only upside we've given up is the price of the insurance, the premium we paid for the put. So any gain on the stock is reduced by what we paid for the put, but the put buyer has protection against the stock falling below the strike price. Let's do a numerical example here. Let's buy a share of stock at 41, and let's buy a 40 put for $3. Well, now our net cost of the strategy, we're in it 44. Our break even on the stock price at expiration, well, if the stock's worth 44, our $40 put is out of the money, it expires worthless, and we're just break even. What's our maximum gain? Well, our maximum gain is unlimited. If the stock goes to $1,000 a share, the only thing out of that gain is what we paid for the put, $3 a share. So the maximum gain is unlimited. What's the maximum loss? Well, remember we said the least you can get for your stock is $40 because you have the put. You have the right to sell it at 40. If the stock goes to 2, you sell it at 40. If the stock's at 38, you sell it at 40. If it's a 0, you sell it at 40. So what's our maximum loss? Well, the least we're going to get is 40, and we're in this 44, 41 for the stock and 3 for the put. So our maximum loss here is quite limited. It's limited to $4. At a stock price of 47, what's our profit? It's $3. We're in at 44. At a stock price of 47, put expires worthless, but we get 47 for the stock, so we made $3. And at a stock price of 38, well, that's below the strike price, so we get 40. We're right back to our maximum loss of $4. So now let's look at our diagrams. Here's our payoff and profit diagrams for the protective put. Okay. Start with a stock like this, and then we have a put with a payoff of 40, an exercise price of 40. So this diagram just says, well, if the stock price at expiration is 38, the put payoff is 2, and we get 40. Another way to look at this, if the stock price at expiration is 5, then the stock's worth 5, but the put payoff is 35, and we end up getting 40. Just another way of talking about we've got the stock and a put at 40, the least we're ever going to get. So the lower the stock price, the higher the payoff on the put, right? The higher the intrinsic value on the put, just enough to offset. So now our payoff diagram looks like this. We get a minimum of 40, And if that put expires worthless because the stock price is higher than 40, then we get dollar for dollar after that, and we draw that 45-degree line. And so our $44 here is our break even on this. So hopefully you're all ready to go on break even prices, maximum gains, maximum losses, and all those other things that we can compute for those two strategies, covered call writing and entering into a protective put position.